Welcome to our True Potential Performance Monitor for November. So today I'm going to analyse stock market returns. Then what I'm going to do is I'm going to look at what are the key issues in markets at the moment. And there's one issue that I'm going to focus on, which is inflation, but particularly rising inflation in the UK. Okay, so let's have a look at the returns now. And as you can see, basically equities are showing quite mixed returns, but bonds in general have been quite negative. And that's because we've seen a sell-off in UK gilts and in UK corporate bonds. However, overseas bonds have fared a little bit better, and that's because we've seen a bit of a currency pickup in this area. One thing I would say is, investors are constantly looking for yield. Yields are very low in the more traditional areas of the bond market, but actually investors can look outside of these areas to the more esoteric parts of the market, so things such as global high yields or emerging market bonds. Okay, so let's have a look at equities. What I'm going to talk about today is Japanese equities, and as you can see, they've been one of the best performers for the month of October. And actually, when you look at Japan, what we're seeing is that the Japanese companies have become much more shareholder friendly. And as well as that, obviously, you've got things such as structural reform, economic reform rumbling along in the background. And then finally, the last thing I'm going to talk about is currency. And as you can see from the graph, UK, so sterling, has devalued, has depreciated against all major currencies. And actually, that is a real negative when you're traveling abroad. But if you're a sterling-based investor who's holding overseas investments, that will actually improve your return. Okay, so let's move on now. Let's look at what is our key theme, which is rising inflation in the UK. And you may well have seen in the news, Bank of England, they've come out with their new expectation of inflation levels for next year, which is around about 2.7%, which is significantly higher than what we've seen over the last 12 months. I think with inflation is completely normal. Now, if you have a normal functioning economy, then you would expect prices of goods and services to rise year on year. But where the problems lie is if prices increase, but wages do not keep up the pace with those increases, or if you see static movement in wages, because then what happens is you end up with a squeeze on disposable income for the general public, and that can cause stagnation in the economy. Okay, so I guess the most pertinent question is, what investments work well traditionally in a rising inflation environment? Okay, so the investments that traditionally work well have been things such as gold, property, inflation-linked bonds, and actually most equities tend to work well in that kind of environment. The area of the market that tends to struggle can be the sort of more traditional areas of fixed interest. And actually what you tend to find is rising inflation leads to rising yields, which can potentially lead to falling bond prices. Okay, so the final area that I was going to concentrate on is cash. So what does rising inflation mean for cash? Now, if you hold cash in a bank account, if you hold cash within an ISA, we're in quite a low interest rate environment at the moment. Cash within ISAs, I guess the average is around about 0.5% interest at the moment. Obviously, if inflation levels are higher than 0.5%, which they are currently, they're forecast to be much higher than that, then actually, by holding cash in these products, you're eroding away at your wealth. So what can you do? I think when you look at cash, going forward in this environment, you will not receive a decent return on cash. Investors need to think a little bit more about risk and risk levels and potentially think about taking a little bit more risk. Here at True Potential, we offer our multi-manager, multi-asset True Potential portfolios. I think when we look at these portfolios, for investors that are seeking income, we have our income portfolios. They produce a yield of 4% a year. But as well as that, they're set up to potentially offer you both capital preservation, but also the chance for some capital appreciation. We recognise that to beat the return on cash, some sort of risk-taking is inevitable. We know that in prior periods, diversification has been shown to reduce risk. Here at True Potential, the portfolios we offer diversification to an even higher level compared to the competitors in the marketplace, and that is around investment style. What this means, so for us, our objective is to manage volatility levels over time, and we encourage investors to take a longer term view when investing. This helps transform risk from something that's quite short term to actually a long term opportunity. By putting all of these things together, it helps the investor to reach their goal, allowing them to enjoy the fruits of their investment later on.
The benefit of multi-asset investing is that you're not just invested in one asset class or single area. Multi-asset investors have the ability to move money between asset classes, countries, currencies, and now with our True Potential portfolios, a new level of advanced diversification, which is around fund manager style. Timing the market perfectly is difficult. This is why we encourage long-term investing and impulse saving upon price weaknesses when these are evidencing in the market. All of this can help you as an investor to enjoy the fruits of your investment experience further down the line. The True Potential portfolios now have over 1.4 billion invested since we launched in October 2015. So we would just like to take this opportunity to thank you for your ongoing support. Now, looking at performance over the month, we're very pleased with the results. All portfolios are showing a positive set of returns. Performance since launch is also showing double-digit figures for those portfolios with increasing levels of risk. What this highlights is that investors that have taken on higher levels of risk throughout this period of uncertainty have been rewarded. However good the outcomes in the short term, it's important to realise that investing is more like a marathon rather than a sprint. One of the key areas that we look at is risk. Both True Potential and our fund manager partners are very aware of risk levels within the portfolios and the funds. What we aim to offer is a good risk-adjusted return. And what we mean by this is aiming to maximise returns within a specific risk band. We will never take more risk than is necessary and certainly not sufficient enough to push an investor out of their risk category. This is something that we continually monitor. There is a growing sense that inflation will pick up in the months ahead. The rule of thumb is that a 10% devaluation in sterling leads to a 1% increase in inflation, but there are a host of factors that can throw the balance one way or another. Inflation may also rise due to the simple fact that the commodity price collapse is coming up in January 2017. And what I mean by this is the anniversary of the commodity price collapse. And this in its own right may push inflation up. Some of our managers use purchasing power parity models, also known as PPP, to assess the fundamental value of a currency. What they are suggesting is that these PP models are indicating that sterling is now undervalued, but may stay weak for longer due to uncertainty around Brexit. Some of our fund managers hedge currency risk and see it as an opportunity to be exploited. Changes which have taken place this month lie within our cautious portfolio and reflect the need to optimise on risk. Every month, we aim to optimise on all factors, and risk is a key element in the mix. What we've done this month is we have reduced our positioning in the True Potential Allianz Cautious Fund and placed the proceeds into the True Potential Schroders Cautious Fund. Looking at the rationale for this, the True Potential Allianz Cautious Fund currently has a higher measure of risk or standard deviation. Taking risk at the start of the year was beneficial for price gains, though now we are reducing exposure as it will help lower interest rate sensitivity risk and help to mitigate currency volatility risk. Both of these effects are higher within the True Potential Allianz Cautious Fund compared to other funds in the portfolio. The reason for the increase in the Schroders Fund is that it brings added fund manager diversification, lowers bond exposure, and the higher weighting in cash helps us to manage downside risk. Looking at the rest of the True Potential portfolios, all allocations have been kept the same, with optimising across our 4 factors continuing to be paramount within the portfolios.
Okay, so now I'm going to turn to our True Potential fund range. What I'm going to do is just examine exactly what the fund managers have been talking about this month. So the first fund range I'm going to start to talk about is the fund range we have with Threadneedle. So our True Potential Monthly Extra Income Fund. And what we're seeing with Threadneedle is that when they're looking at the UK equities, they are seeing quite a few opportunities. I mean, an example that they've given is BT. Obviously, BT have that huge pension deficit, which the market sees quite negatively. So it means that Threadneedle can pick up BT stock potentially a little bit cheaper compared to other stocks that are in the market. I think they look at a mixture of types of stocks. So they look at very much the traditional income cash compounding stocks, but as well as that, they can look at smaller growth stocks as well. And they do that because it's an extra way to add to return. I think when we're looking at dividend growth, they're saying that they believe equity dividend growth within their fund could potentially grow at around about 3%. And also lastly, on Brexit, they're actually a little bit more bullish around Brexit compared to some of our other fund managers. Okay, so let's move on. Let's have a look at the True Potential fund range managed by SEI. And as you look at the returns, I think the first thing to say is that the returns have been excellent. We've seen some really good positive growth from SEI. I think looking at what are the key themes that SEI is seeing right now, I think the first thing they're talking about is currency. So obviously SEI, when you look at their returns, quite a bit of that has come from the positivity around their currency positions. I think what they're saying as well is they hedge out currency when they look at their bond exposure, but they're willing to have unhedged positions when they look at their equity exposure. They expect an interest rate rise in the US later this year, but they feel that actually that'll be fairly modest. I think as well as that, just looking at fixed income, the exposure is very much short duration, so less sensitive to changes within interest rates. That has been a bit of a negative when you look at their returns, but currently they believe that's the best place to be. Okay, so let's move on. Let's now move on to the True Potential fund range that's run by Close Brothers. I think Close Brothers feel that the main risks that we're seeing at the moment are political risk. So that is mainly around the US election. As well as that, they're also seeing other risk, which is around interest rate risk. So what happens if the Federal Reserve raise rates? And finally, what they're saying is they're a little bit nervous around what happens with the upcoming company earnings season. Within fixed income, yields have picked up, and actually Close is saying that if this continues, they feel that this asset class could well become more appealing. They still favour a growth sort of style compared to value. And for currency, they're 50% hedged at the moment. And they've done that to reduce risk. It's actually hurt performance a little bit if you look at it year to date, but they're happy with their current positioning. Okay, so let's move on to Allianz. Again, Allianz, the True Potential fund range run by Allianz, has performed very well over the month. They were quite cautious in September, a little bit nervous that the Fed could be potentially raising rates. So what they did is they built up quite an underweight position to sterling. So by the middle of the month, they're only about 40% exposed to sterling assets. Allianz have sold down their emerging market bond position, but they are still retaining their emerging market equity position. So they're still happy to be invested within the emerging markets. I think finally what they're saying is any kind of increase in volatility that they're going to look to increase their positioning towards cash and also carefully managing their sterling US dollar exposure at the moment. Okay, so next let's move on to 7IM. And looking at what are the key themes that 7IM are looking for at the moment. So the first is currency, in particular movements in sterling and sterling's weakness. The second is around intra-market trade among Asian nations. The third, inflation, so something that I talked about within our key themes and the potential for it to pick up. And the final thing is the importance of diversification. And what they're doing here is they're looking to the more alternative areas of the market. In fact, they've actually just hired an alternative specialist to help them gain more access to these areas. Okay, so next let's move on to UBS. And when we look at the UBS fund range, what you can see is that you've seen a positive performance for October in general. The area that performed quite well was they've got a currency hedge fund in there called CARS, and that really helped to lift up returns. The areas that maybe detracted from performance were investment grade credit and their long dated bonds. I think markets are becoming much more increasingly correlated and have only been like this 3 times this century, and it's always because of action that's been taken by central banks. However, UBS do remain broadly positive and regard the current market environment as favouring risk assets. Let's move on to the true potential fund range managed by Schroders. And we've seen some really good returns from Schroders. And the main reason for that is that they have an underweight position to fixed interest. Actually, if you speak to the fund manager, Marcus Brooks, he said he'd rather hold cash compared to certain areas of the fixed interest market. I think looking further ahead, looking at currency, they see sterling as good value. However, they feel that it could go even lower if there is a hard Brexit, but if so, they feel they'd be looking to buy. Okay, lastly, I'm going to talk about the 2 Goldman Sachs funds, so Goldman Sachs Income Builder and Goldman Sachs Dynamic. Starting off with Dynamic, Goldman Sachs have increased their equity weighting within the Dynamic fund. Biggest increase has actually been to the FTSE 100, so that's now up at 30% compared to their strategic asset allocation of 26%. They've done this basically around what they say are their technical indicators, and what they feel is that the Bank of England will continue to defend the economy. Moving on to Income Builder. Income Builder's offered you what's a very good return, but excellent dividend yield prospects as well. And obviously Income Builder pays a dividend yield on a monthly basis. In Europe, they've actually got quite a large position. Obviously Europe's been hit quite badly compared to the other developed markets, and Goldman Sachs feel like there's some really good attractive valuations there. Okay, that's everything for me this time. I'd like to thank you very much for listening. If you'd like any more information at all, please use the contact details on the slide in front of me right now. Thank you. Speak to you next month.